Today, we're diving into one of the most durable investment ideas ever, value investing. Now, the theory is pretty simple, but let me tell you, putting it into practice is incredibly tough, especially in a market like ours that just seems to reward the fastest, most speculative plays over good old-fashioned patience. The guy who invented all this, Benjamin Graham, he had this great way of putting it. He said in the short run, the market is a voting machine. It's just a popularity contest. But if you wait long enough, it becomes a weighing machine, where the real substance of a company is what matters. This one question, right here, is the key to the whole value investing worldview. And of course, you can't talk about Graham without mentioning his most famous student, Warren Buffett. He took that whole philosophy and boiled it down to this one perfect line. It's all about being a contrarian, about having the discipline to go against the herd. And honestly, that's the hardest part. So let's get into it. What is this philosophy, really? Well, it all goes back to Benjamin Graham and this one central idea that he believed was the absolute bedrock of investing safely. And that idea is the margin of safety. The best way to think about it is like building a bridge, right? If you know 10-ton trucks are going to cross it, you don't build a bridge that can hold exactly 10 tons. No way. You build it to hold 15, maybe 20 tons. That extra capacity, that's your margin of safety. In investing, it just means buying something for way less than what you figure it's actually worth. Okay, so that's the big idea. But how did Graham turn this concept into something you could actually use? Well, he came up with these formulas to find what he called net nets. These were companies that were just ridiculously, unbelievably cheap. His most famous tool was the net working capital formula. I mean, this thing is so conservative, it's almost paranoid. The whole point is to find a company's absolute rock-bottom fire sale liquidation value. You're looking for businesses that are trading for less than the cash they'd have left over if they just shut down, sold off their stuff, and paid off all their bills. All right, enough theory. Let's make this real. We're going to use the router company Netgear and their numbers from 2023. We'll just follow 3 pretty simple steps to see what Graham's formula says their rock bottom value is. So here are the numbers straight from Netgear's balance sheet. But someone like Graham would never just take these at face value. Nope. He'd look at this and start slashing, because he knew that if a company has to sell things in a hurry, it's never going to get full price. Okay, first step, adjusted current assets. We take the cash at 100%, sure. But the money customers owe them, he'd only count 75% of that. And all that inventory sitting in a warehouse, he'd say it's only worth 50 cents on the dollar. After those huge discounts, Netgear's current assets drop to about $547 million. Next, you take that adjusted number and subtract all of the company's liabilities, every single penny it owes. What you're left with is just under $180 million. And that, according to Graham, is the pile of cash that would be left for shareholders if they literally shut the doors tomorrow. And here's where it gets really interesting. You divide that cash pile by the number of shares and you get a value of $6.18 per share. So a classic value investor would look at that number, then look at Netgear's actual stock price. If the stock was trading at, say, $4, they'd see a massive margin of safety. That's the bargain. But, value investing isn't just about this cold, hard math. Even Graham knew that. And over the years, the idea of a margin of safety has grown to include stuff that's harder to measure but just as important, like is it actually a good business? Yeah, modern value investors talk about these other sources of safety, like a super strong balance sheet, which is a cushion for bad times, or sustainable growth, which means the company's value is actually growing over time. And my favorite, a competitive moat, like a strong brand or a patent that keeps competitors away. That protects your profits. But here's the thing. Knowing all this is one thing. Having the stomach to actually stick with it, that's something else entirely. Value investing is a trial by fire. It tests your discipline like nothing else. And there is no better story about this than what happened to the legendary investor Seth Clarman during the dot-com bubble. So, picture this. It's mid-1998. The tech bubble is getting bigger, and Clarman is sending out letters to his investors basically saying this is insane. He saw that people were just buying stocks hoping an even greater fool would come along and pay more. The price had nothing to do with the business anymore. And I mean, look at this. This shows you how much it cost him to be disciplined. While the market was just going vertical, his fund was struggling. In 1998, he was down over 16%, while the S&P 500 was up almost 27%. Can you imagine the pressure, the phone calls he must have gotten? It must have taken an incredible force of will to not just give up and buy what everyone else was buying. By the end of 1999, at the very, very peak of the mania, the pressure was just immense. And what did Clarman do? He wrote this. He said giving in would be foolhardy, irresponsible, unconscionable. For him, this wasn't just about making money. It was about protecting his investors' capital. It was about integrity. And here's the kicker, the real insight. He didn't see all this craziness as a threat. He saw it as a massive opportunity. While everyone else was selling their boring stocks to gamble in the technology stock casino, he was on the other side of that trade, just greedily scooping up great companies at what he called giveaway prices. Clarman's story just proves that the biggest battles in investing are fought inside your own head. Which brings us to right now and the huge challenge of AI. The core ideas of value investing, diligence, patience, thinking for yourself, those things are timeless. But how do they apply in the age of algorithms? Well, according to a big survey from the CFA Institute, the pros are worried. And their number one concern, these AI algorithms are basically black boxes. If you have no idea how the AI is making its decisions, how on earth can you trust it with your money? It makes sense. So to deal with this, the CFA Institute put together a framework. And when you read it, it's going to sound super familiar. It's basically the principles of value investing, just repackaged for AI. Make sure your data is good, check the model's work, demand to know how it thinks, and, this is the most important one, make sure a human is always in charge and accountable. This quote just nails it. It's saying that even with these incredible new AI tools, your fundamental job as an investor doesn't change one bit. You still have to do the hard work. You have to understand the data, you have to question the answers, and you have to make sure the whole process is solid. It's the exact same deep thinking Graham was talking about almost 100 years ago. Which really leaves us with this one big question to chew on. As algorithms get smarter and faster and data gets bigger and bigger, maybe the most valuable thing isn't a better algorithm at all. Maybe, just maybe, the ultimate margin of safety is that timeless, disciplined human judgment that knows when to be greedy, when to be fearful, and when the market has, once again, entered greater fool territory.